Good morning, ladies and gentlemen. I've decided to start this week with the current fundamental indicators so we can see exactly where we are within the economic cycle. We start off with the Citibank Economic Surprises Index, which has been ticking up slightly over the course of the past quarter from very low levels, and still it is way below the previous peaks which were recorded in the first quarter of the year. This just means that the economy has been performing slightly better than people have been forecasting. Next, we have the ISM manufacturing and non-manufacturing indices, and these are extremely important because every time we have been below 48, we have had a recession. We are now at cycle highs around the 60 level, and nobody can argue that those are not good numbers. However, there has never been a recession in the United States which has not started from very high levels of the ISM. It is, if you go and have a look at it, recessions has always started from very high readings in the ISM. Next, we have the S&P 500, the 12-month trailing earnings, and and naturally where we are in terms of price. You can see that we are very over close to the trailing S&P 500 earnings, and you can see how much closer we are to it in terms of percentages than we were even in 2007. And finally, we have the global economic data expectations in 2017. Now, what is interesting is that global earnings are higher, and we can see that from the next chart. Global earnings are hitting a new all-time high. That is indisputable. So what we are looking for is a divergence between what the US economy has been doing for the past few quarters and what is forecast for the world economy over the next 12 months. And as a result of these expectations, we have the S&P 500, the forward earnings, touching the 18 times Blue Angel. This is the first time in history since 2000 that we have managed to touch the 18 times Blue Angel. Can this continue? That is the question that everybody has to ask themselves, and are we paying way too much for US equities as opposed to world equities? And here we have the weekly chart of the S&P going all the way back to the very low in early 2009. We can see that really the price has been trading in a very nice upward channel, only very rarely coming out below it. What is interesting is that we are now, and we can show you this if we have a look at the current situation, we are now for a very low probability at a level which is higher than the Bollinger Bands on the weeklies. We have gone back and calculated that the market has never not retraced and traded back from the break of the Bollinger Bands, which level comes in around 25.30. The market always tests the moving averages on the weeklies and finds support at that level or resistance at that level. As you can see, 25.30, probably it'll be 25.35 for next week. Between 25.30 and 25.35 will be the extremely important level which we mustn't trade below if we are to avoid coming all the way back below 2500 to around this moving average, which will be around the 2490 level for next week. And here we have the comparison between what the US market has been doing and what the emerging markets have been doing. Something like 70% of all the growth and all the expectations for this year and next year come from upgraded earnings in the global economy as opposed to the US economy. That should be reflected and is being reflected in emerging markets outperforming the US market. The US market is at such overbought levels fundamentally and technically that it just cannot sustain these levels compared to the emerging markets picture. If we now zoom out in the emerging markets, we can see that earlier this year it broke the downtrend channel which had been in existence all the way since 2008, and it's now on a tear back up to test the level around the 55 level, which would be another 20% higher than we are at the moment. Our contention is that it's emerging markets which are dragging up the US as opposed to the other way around. We would love to see this. To us is 3 of 3 in emerging markets. We will love to see a pullback to around the moving averages around the 44 level at some stage over the next few weeks before we have the fifth wave all the way back up to 55. In either case, we are convinced that within the next 6 to 12 months we will be trading significantly higher in emerging markets around this 55 area while the US languishes. And here we have that spread. You can see a lovely retest of the levels that we thought were extremely important, and now it's on the way to make new highs against so this is EEM over SPY, emerging markets over the S&P. We think that over the course of the next couple of years we will definitely trade at 25, and that is probably 30 to 40% higher than we are now. So that would be the equivalent of the S&Ps doing nothing and the emerging markets being 30 to 40% higher. As you know, we have been saying that the trade is long emerging markets, short S&Ps, long XLK, because XLK is America and is the driver of the US economy. That is what the comparative advantage is of the United States. XLK against SPY is now, after a brief correction, beginning to make new highs, or certainly testing the old ones, suggesting that this relationship is very much alive. XLK will go up or come down less than SPY, looking at it over the very long term. On a weekly look, XLK SPY, you can see how far the market still has to go to reach the top of this channel. It is still another 10% at least in terms of outperformance by XLK over SPY. Another potentially familiar chart to you, this is the all world index as opposed to the S&Ps. You can see that now the 200-day moving average has actually turned upwards for the first time since 2010. So since 2010, we have the first upward sloping moving average in the old world index as opposed to the S&Ps. This cannot be a coincidence. This is something very significant. We are on the cusp of a revaluation of the world relative to the US. Now, how that fits in with your political views and whether you think that Trump has caused this or Trump will cause this is neither here nor there. The market is telling you that there is something rotten going on in the US compared to the rest of the world, and it really would pay for you to pay attention to what Price is saying. Price is saying something very bad is coming to the US and something very good potentially is coming to the rest of the world. How does that fit in with what the bond market is telling us? Well, it does. The bond market over the past few days, this is TLT, so long bonds basically, tested the 200-day moving average, passed the test with flying colors, and is now back towards the middle of the Bollinger Bands and is giving a buy on the MACD. What we think is going to happen is consolidation for a few days, and then we think it's going to break higher and this time bust through the 130 level, going all the way up towards 134. This is going to be a very, very important indicator of risk off coming in the next few days. Yield chart of 10 years. 10-year notes, very important. Sustained the test of the 200-day moving average. Bollinger Bands now compressing, a few days, possibly 10 days of trading in this range, and then volatility is going to explode. We think that the volatility will explode to the downside, but we are definitely prepared to buy straddles here. Once the Bollinger Bands have come in, it is going to be a sustained move. We think the move will actually take out the 2% and come back all the way down towards the 180 to 185 level over the course of the next few weeks. That is going to be very, very risk off, and we think that there is something certainly on the horizon that is going to be very interesting for the United States over the course of the next few weeks. How does that view square with what is happening to the dollar index? Well, what we think is going to happen is consolidation for a few days, just like in the bonds. The market will then get all excited about an inverse head and shoulders, which will fail and we will collapse into year end. That, we think, is far more likely than we go up and retest the 97 level. There is a definite lessening of the bid for the dollar. The dollar is not a currency in demand. That might have a lot to do with what is going on in China and the growth of the Asian middle class compared to the US and European middle class, but the dollar seems to be a lot less in demand than other assets and other currencies. Another risk-off asset, gold, is beginning to show signs of life. This is a very interesting chart to us, and we are starting to buy some gold. We think that there is a distinct possibility that over the course of the next few weeks we might go all the way up here towards the 1500 level and test it. Everything that we look in the longer term is telling us to get out of US equities and invest all our money somewhere else. everything apart from XLK. So that is what we're doing. It is illogical to keep your money invested at 18 times forward earnings when you can do a lot better for it in a currency which is not depreciating as much as the US dollar. So even things which have no yield are telling us to get out of expensive US equities. Finally, a chart of the Dow Jones transports, because that sometimes gives hints that people tend to miss if they just look at the Dow Jones industrials. On Friday we had a key reversal. Nobody really noticed, nobody paid much attention, nobody much cares. The Dow Jones industrials still went up, the S&Ps still were bid, the Nasdaq still went up. So people completely ignore what doesn't suit their narrative. If we try to enlarge this, we can see how significant this might well be. It was not a small range. The market opened above the previous day's high, went up, tested higher levels, came back and closed on its lows, making a key reversal. Now, totally bullish markets do not make key reversals at the top. Now, could this market reverse? Well, of course it could. But it is just a sign that something which is trading outside of the weekly Bollinger Bands, like the S&Ps are, is not going to be able to sustain that momentum when the Dow Jones Transports is making a key reversal. So we definitely think that if you don't want to be outright short of the States, you spread them against emerging markets, you spread them against any other market which is significantly cheaper, because we think there is definitely something going on in the States which is going to be very detrimental for your returns over the medium term. In conclusion, just a couple of words about the two sectors which have been driving the S&P over the last couple of weeks to these record territories, and those are XLF and XLI. This is a chart of XLF, 300 minute, which is a time scale that we like. We have here now a market which is very tired and is within constricting Bollinger Bands. If we actually try to enlarge this area, we shall see that the market is not being able to trade higher than the moving averages, which are now turning down, while the upper and lower Bollinger Band are constricting. This is telling us at best that this market over the next few days is going to be neutral and therefore not a help to the averages. The S&P is unlikely to go to new highs with the help of XLF. Let us now look at XLI. And this is XLI, and this has even more worrying patterns to it. You can see how it opened higher on Friday. Let us enlarge this. This is, to us, a very important indicator. It opened much higher and it closed right on its lows. If we now zoom out, we will notice something very interesting in these indicators. We will notice that the RSI has made a new low without making a higher high. The RSIs are showing a divergence, and so are the stochastics, which have made a new low. XLI is likely to come at least down to this level, 71.20. That is 1.5% lower, which we think is very likely to make the S&P go down towards the 25, 30 level. That is going to be so important. If it does not hold there, it's going to be much, much worse for the S&Ps. But one step at a time. XLI is showing us the way. We think that it's a sell from the open Monday, and by Wednesday it should be testing this trend line, which is about 1.5% lower. So by Wednesday we expect the S&Ps to be around the 25.30, 25.35 level. Our biases for next week are completely unchanged. We still think that at some stage it's going to be a fantastic trade to buy straddles in fives, tens and 30s. We still think that ES has nothing in the tank. It will definitely come back at some stage. We think even by Wednesday, as we just showed you. And finally, the butterfly is long XLK, short SPY, long EEM. We think that is a winning trade, and we are now becoming convinced of it from both the technical aspect and the fundamental aspect of the trade. Thank you very much indeed, and tweet to you on Monday.